Let's speak to Lothar Mentel, the Chief Executive Officer at Octopus Investments, which has more than £1.5 billion under management. Thank you so much for joining us. We do appreciate it. So Prudential, of course, having its annual general meeting today. What are your thoughts on the company's situation right now? Do the vast majority of big investors want to see some change at the very top?
Well, the majority of investors is pretty disappointed about what happened here over the last couple of weeks. Not very good at all. Somebody will probably be accountable for it, but I'd be very sad to see Tidjane Thiam leave the company or step down. He brought some fresh blood into the industry, some pretty progressive moves. I think that was the right direction for Prudential. I would ask why the whole approach was quite so bungled. If you're paying that much money for investment bankers, surely they can prepare this a little bit better.
I guess that's why there are some calls, for heads to roll.
Yes, for heads to roll, but I think it would be sad if it was the wrong heads, those heads that are bringing a little bit more a progressive mood into the UK insurance industry, and expanding in the Far East is certainly the right step forward. Which
is what he says is their strategy now, that Asia
Indeed.
Will continue to be the focus at the forefront of the company's plan going ahead.
Indeed, indeed. I think what we're seeing at the moment there is almost the same that we're seeing in the markets. We've moved from a sort of new confidence that we saw after Easter to a complete loss of confidence again, and everything seems to be impossible again, and that's quite a bit of an unnerving move recently.
Exactly, because we've seen stocks right across the globe, in the US, Asia and Europe last week. They've been falling after disappointing US jobs data, also continuing concern over the European debt crisis. Is this likely to continue?
I think it might continue for a while, because we're currently seeing the government from moving to be a stabilizing factor in the world economy to be more of a destabilizing factor as they're trying to appease their own local electorates. They're making more and more populistic statements, really, to their domestic audiences rather than internationally, but the markets are very happy to listen. And what unnerves me a little bit is that even a Barack Obama recently seems to have lost his calm and comes out with quite loud statements where you think, where did that come from?
So stock investors should brace for higher volatility?
Volatility, definitely. At the moment, we unfortunately do have that, but those times also offer some of the better buying opportunities. The recovery is still intact. We still see it more at the moment as a mid-cycle softening rather than a reversal of what was going on. Therefore, valuations still look pretty attractive to us.
Exactly. Tell me more about the better buying opportunities at a time when the market is tumbling.
Well, it was interesting. At the beginning of the year, it became more stock specific. At the moment, now that fear has returned, emotions have returned so much, it almost is back to, doesn't matter. You buy the dips. You buy when the market gets particularly unnerved about something.
Across a broad range of industries. It's not stock-specific necessarily? Not
necessarily, no, not in this risk-on, risk-off game at the moment.
What are you focusing on right now?
Well, we're still focusing on the better moving economies, so the US, Asia, corporate bonds rather than government bonds, pretty short or underweight Europe. That's what we're focusing on, but otherwise, I'm afraid it's a little bit back to the trading game.
And what is your long-term investment strategy in this current environment of uncertainty and volatility?
Don't lose your head. That's the main investment strategy. Things will continue to improve. It isn't currently looking like a reversal and a double dip, so we're sticking in there, and we're making the best of the opportunities that volatility offers.
So how do you think, you're saying that there won't be a double dip, how do you think companies are going to perform in both Europe and the US during the rest of this year?
I think the double dip has a lower probability than the continued recovery, and once the fear abates a little bit again, those companies that have prepared better or have come out better of this recession with more cash will do better, and therefore active management and stock picking will come to be supportive of strategies again, whereas at the moment I'm afraid it's just a matter of fear or risk on, risk off.
So you're saying that some companies will see strong top-line revenue growth?
Oh yes, we're already seeing strong top-line revenue come through, but there will be companies that are doing better than others, and that's what we active managers have to focus on.
And what about the prospect of further write-downs for European banks, very briefly?
Well, I've said for a while that I'm concerned about the Spanish banks. Generally, the European banks did not go through the same catharsis as the Anglo-Saxon banking world, but they're also in a sweet spot at the moment and have been. Very different situation to 2 years ago. They have been able to rebuild their balance sheets through the very low interest rates, the higher margins.
Okay.
So I think they should be better positioned now.
Lothar Mentel, Chief Investment Officer of Octopus Investments. Thank you so much for your time.
Thank you.